Brings us to our guest right now to talk about the odds of a recession and the wild week we've seen in the markets. James Camp is Managing Director of Strategic Income at Eagle Asset Management. Our guest host for the hour is Joe LaVorgna. Joe, you said that you think the central bank's going to come and save us. Ray Dalio says he's not sure it will be effective.
Well, he said 40% chance, so it won't be a recession. But I saw the notes that James had, and what I wanted to ask him basically is, the yield curve's inverted, but the credit spreads actually are still pretty contained. So that would tell you maybe the Fed still has some time to actually ease and get ahead of things before credit markets deteriorate. Because as you were saying in your note, when credit deteriorates, then you've got some real problems.
Yeah, we've had a number of conversations about which yield curve matters. And I remember last we visited, it was actually back in the fall. We had a 3.25 10-year. We had the Fed telling us that short-term rates had to go up significantly. And I looked at that December experience as a deleveraging moment. The folks that fund at LIBOR were all of a sudden looking at an expensive world to fund their positions. Now we're looking at the 2s to 10s, and that is probably a better real economic signal. But to your point, Joe, if credit spreads are still positive, meaning short credit spreads are 70, 80 basis points, long-term spreads are higher, the math of financial engineering still works. Credit is still readily available. And as you probably are aware, most of the investors out there looking in the credit space want that short credit and they want yield. And so there's an ample amount of activity in the short end of the credit curve to keep us from a credit inversion, which always sets up.
But you don't think what we've been seeing is a signal of a recession coming just yet? I
think the bond market is telling you loud and clear global slowing, that it's been that way for a while, that inflation is a non-starter. I am suggesting that what we have done is we've created a massive credit cycle in the U.S., and that credit cycle is likely to continue giving the credit configuration. Real economic activity, I might even be higher than Mr. Dalio on the recession probabilities. And the reason that I say that is we are curtailing in the face of tariffs and trade talk and Federal Reserve, complete policy blunder. Let's call it what it is. I've been doing this for 30 years, and I've never seen a retracement of a Fed misstep as aggressively and as quickly as we've seen over the last 6 months. But we're still seeing...
is that good news or bad news? They made a misstep, and you think they're trying to correct it quickly and actively?
I think they're trying to quickly correct it, but I think the policy mistake that was on the table in November would have put us into recession, full stop, unambiguously. But the point that I would make is we're now seeing a slowing in CapEx, which was really exciting to us. We were seeing an acceleration in CapEx. We were seeing productivity growth, all kinds of good stuff.
But that was cut short.
It's been crimped by trade and by uncertain global growth.
Because businesses don't feel confident.
Economists have been around since the beginning of time, obviously. I'm still waiting for one actually to be right about something. But
careful, Joe, careful.
Sorry. But you would think that we would have, at least someone would have made the point that maybe it's not the absolute level of interest rates, it's where we are versus the rest of the world that determines things. And no one made that point. No one could believe that the Fed could be too tight at these low levels. No one took, but why didn't they take into account all these other countries and currency factors when you've got other countries, that are much lower than you and that got the spigots turned on high and are doing QE or negative yields or whatever? Even if you're only at 2.5%, you're still so much higher than they are that you can actually cut off the economic expansion with rates that low. But economists didn't think that we had a problem until 4, 5, 6% on the way back.
And I think, to your point, we've globalized central bank activity. And that's the story of the post-crisis period, that central bank policy is fungible. It doesn't matter where the machines are turned on, just that they are. And we've seen that throughout this cycle. The Fed cannot afford to be completely out of phase. And I think that's unfortunate.
But for that reason, you can't blame the Fed that much, because if not a single pro-economist warned that we could get too tight under 2.5%, then why should they have known? Did you warn?
Actually, I'll
it's
CNBC. No, but
you
I wrote
wouldn't
a piece,
think that logically that you could be too tight when you come down from 8 to 0.
Yeah, well, James may agree with me, but the thing is, if you look at the Fed and where neutral rates theoretically could be, perhaps a lot lower than the Fed thought. And I wrote a piece for CNBC online back in February of 18. I said, the Fed needs to steepen the curve. They should stop with rate hikes, stop at 2, actually maybe let the balance sheet sell off a little bit because there's a shortage of high-quality liquid duration assets, and try to steepen the curve. So I think it's there, Joe, but I'm guessing James might agree that the Fed is just way too academic, and I use that pejoratively. They're too model-centric, and they're too into the numbers and the math, and need to focus more on the practicality of things.
Although Jay Powell doesn't come from the economic side of things,
but he doesn't,
from the academic side of things.
That's true, but the problem is that you still need to know the economic history, and have to at least be a practicing economist, and unfortunately his experience hasn't been that.
And that really set up why the yield curve was so incredibly inexpensive back in the fall. At a 3.25 10-year Treasury, we had prognosticators all over the streets, and very prominent luminaries in New York saying we're on our way to 4, on our way to 5. The retail investor was not served by that because it was probably one of the better entry points that we've had in this cycle. I like what you're saying about scarcity of duration assets, and maybe I'll leave at this point. 30-year Treasuries at all-time lows. Pension funds still have to fund long-term liabilities. Yeah. There is a scarcity of long-duration yield. And that's why we're seeing this massive rally in the long end of the Treasury curve. 30-year Treasuries at 2%. That's pretty extraordinary.